Hello, and welcome to our channel Pursuit of Wealth. This channel is your ultimate destination for learning about finance and wealth, investing in crypto, informational and educational trends in finance management. If you are someone who wishes to become wealthy and looking for smart money management options, then we are fortunate to have found each other. Making money from the stock market is plain sailing if you are making investments in stocks for a while. And the drill for this is pretty simple. You buy a stock at some price and then sell it at a higher price. But this is not as simple as it looks. What if the stock prices fall lower than its purchase price? How are you going to deal with it? And how can you find the right price for a stock? Well, there are certain key metrics to get the solution for these questions. You can find many strategies that can help you to reach your financial goals. But one strategy is to find fundamentally sound companies with undervalued stocks. You can find the most undervalued stocks that you can buy and start your investing journey in our previous video. In today's video, we will look at some of the key metrics that you must understand and consider before investing in undervalued stocks. So, stay tuned to find out. The general key metric for investment in undervalued stocks for every investor in the market is intrinsic value. Determining a stock's intrinsic value is the most important thing, which is the calculated value of a company using fundamentals analysis. This takes into account many quantitative metrics that are essential for investing in undervalued stocks. Intrinsic value is often considered as a base case. Analysts and investors rely on using several ratios to provide easier and quicker estimations for the price of the stock. The ratio analysis is often considered in conjunction with intrinsic value calculations. There are many ratios that investors can study and use, but these financial ratios can be really helpful for analyzing a stock. These are the 7 financial metrics that one must consider before investing in undervalued stocks. Number 1. Price-to-book ratio. The price-to-book ratio is calculated by comparing the net value to a company's market capitalization. This ratio tells whether a stock is undervalued or overvalued. It usually indicates that the stock is potentially undervalued because, in the market, the value of a specific company is less than its on-paper value. A P/B ratio is a valuable tool for determining how much investors are prepared to afford each dollar of a company's net worth. Well, the price-to-book ratio of 0.95, 1, and 1.1 indicates that the stock is trading at nearly book value. In simple words, the P/B ratio is handier if the number is greater and differs from 1. Also, smart investors often prefer companies that have a market value less than their book value. So, by understanding the difference between book value and market value, you can have more investment opportunities. The more significant difference between the values of the P/B ratio is a green flag for buying the stock. Also, you can find the P/B ratio of a company through assets minus liabilities per share, which is taking the price of a share and dividing it by its book value. Moreover, by going through a company's financials, you can find its assets and liabilities for use in your calculations. A simple online search can also be useful, and it can lead you to a significant figure that you can use. Number 2. Price-to-earnings ratio. This ratio is used to know the price that the market is willing to pay for the stock. The required ratio is based on the stock's past or future estimated value. It also helps to determine the undervalue or overvalue of the stock. The price-to-earnings ratio is another key indicator that helps in identifying the market value of a stock compared to the total earnings of the company. If the P/E ratio is high, it means that the stock is expensive and so is overvalued. If the P/E ratio is low, the stock price is low, so the stock is undervalued. This P/E ratio can help investors to find undervalued stocks. However, there are some limitations to the price-to-earnings ratio. Because a company's earnings are based on its forward earnings or historical earnings, and these are based on the opinions of analysts of Wall Street. Therefore, earnings can be difficult to predict because past earnings do not guarantee future results. Also, the opinions of analysts and their expectations can be wrong. In addition, price-to-earnings ratios don't factor in earnings growth, but we'll talk about the limitation with the PEG ratio later in this video. Number 3. Debt-to-equity ratio. The debt-to-equity ratio, D/E, shows how a firm finances its assets. It shows the proportion of equity to debt a company uses to finance its assets. The low debt-to-equity ratio tells us that the respective company doesn't derive a significant part of its financing from its debt. Similarly, a high debt-to-equity ratio means that the company uses a higher debt amount for funding than shareholder equity. It can be disastrous for companies, especially in certain economic climates. Large debt is a substantial reason behind companies that have gotten out of business. This D/E ratio can be calculated by dividing the total liabilities of a company by its shareholders' equity. These can be found on the company's balance sheet. The acceptable debt-to-equity ratio varies among different industries. That's why this ratio doesn't remain the same, as it varies from industry to industry and from time to time. These ratios don't define the low budget of the company, because debt is often used to generate more income streams or to expand operations. Industries like construction and auto typically possess higher ratios than companies in other industries. But instead, this ratio allows you to compare different companies and their reliance on debt to run their operations. Number 4. Price-to-earnings to growth ratio. The price-to-earnings to growth, or PEG ratio, is a refined version of the price-to-earnings, P/E ratio, that includes earnings growth. The price-to-earnings ratio doesn't always tell the appropriate ratio for the company's forecasted growth rate. The price-to-earnings to growth ratio tells investors about the relationship between the P/E ratio and earnings growth. By examining both the current earnings and the predicted growth rate, the PEG ratio provides a full view of whether a stock's price is overvalued or undervalued. Generally, a stock with less than 1 PEG is considered an undervalued stock, because its price is low compared to the company's expected earnings, whereas a stock with more than 1 PEG is overvalued, as it indicates that its price is high compared to the expected earnings growth. This ratio is calculated by taking the P/E ratio and dividing it by the expected future earnings growth rate. Since the price-to-earnings ratio doesn't contain future earnings growth, the price-to-earnings to growth ratio provides a big picture of a stock's valuation. So, the PEG ratio is a crucial metric for every investor because it gives us a forward-looking perspective. Moreover, this ratio can be useful for comparing companies with the same industry. Number 5. Free cash flow. Free cash flow, or FCF, is the cash originated by a company. The company produces this cash through operations, excluding its expenditures. To put it another way, free cash flow is the cash left out after a company pays its operational and capital expenses, or CapEx. Free cash flow signifies the growth of the company by having a look at the remaining payment after spending on the operations and capital expenditures to reward shareholders by share buybacks and dividends. Investors can easily indicate the future growth of the income and thus can decide the better investment plan. The high value of free cash flow tells us about the high income. So, if a company has an increasing free cash flow, it could be because of sales growth and revenue or cost reductions. In simple words, the increasing FCF could reward investors in the future. That's why many investors cherish free cash flow as a key metric. Well, knowing the market capitalization of the company and dividing it by its free cash flow will provide you its price to FCF. The smaller this number is, the more stock will be undervalued because you will pay less for better or increasing cash flow. Generally speaking, the rise in cash flows precedes an increase in earnings. Number 6. Price-to-dividend ratio. The price-to-dividend ratio, P/D, is used for analyzing the dividend stocks. P/D ratio metric lets you know how much investors are ready to pay for every $1 in dividend payment that the company pays out over 12 months. The ratio is very handy in determining the value of a stock against itself after some time intervals and also other dividend-paying stocks. This ratio can be calculated by taking the company's annual dividend rate and dividing it by its earnings. P/D ratio varies from industry to industry accordingly. Number 7. Price-to-sales ratio. The price-to-sales ratio is mostly known because most companies do have sales. and the sales also indicate some type of growth rate. The price-to-sales ratio is calculated by dividing the current stock price by its 12-month sales per share. You can find the current stock price by plugging the stock symbol into any of the trusted finance websites. The sales per share metric are figured by dividing the number of outstanding shares by the company's 12-month sales. In simple words, you find the P/S ratio by dividing the annual revenue of a company by its market capitalization. Also, the low P/S ratio when compared to the competitors suggests some undervaluation of the stock. On the other hand, a high price-to-sales ratio indicates the overvaluation of the stock. Moreover, this ratio can be really helpful for comparing companies whose earnings are not clear and don't give you a complete picture of the company's overall growth. Well, that's it for the video. These are some essential key metrics that you consider before investing in undervalued stocks. The key takeaway for the video is when you are looking for a stock to invest in, it is essential to use all the above metrics to compare potential investments, because a single metric like the P/E ratio doesn't give you enough idea and detail to make a decision. So, if more than one or multiple metrics seem to be true for stock, go for that because you may have found a market inefficiency that can be a good investment opportunity. We hope you find this helpful. If you like this video, don't forget to share your thoughts and strategies to invest in the comments section down below. As always, thank you so much for watching. We will see you in the next one. Please subscribe to the channel, like the video, and press the bell icon for more amazing content about wealth management and finance-related videos. Success is coming your way. Keep your doors open. See ya till the next time.